A dollar sitting in your drawer for 10 years is not the same dollar when you pull it back out, even though the number printed on it never changed. That is the strange trick of money that almost nobody explains clearly, and once you see it, you cannot unsee it. The number stays the same. What that number can actually buy quietly shrinks. Today, we are going to open up the machinery behind that shrinking, because inflation is not some abstract headline about the economy. It is a mechanical process happening to every dollar, euro, or peso you hold right now, whether you are watching it or not. Let's start with the core idea, purchasing power. Money itself has no value. A dollar bill is just paper. What gives it value is what it can be traded for: bread, fuel, rent, a haircut. Purchasing power is the real question behind every price tag. It is not how many units of currency you have, it is how much stuff those units can actually pull out of the world. And here is the mechanical fact worth sitting with: purchasing power is almost never fixed. It drifts, and it drifts in one dominant direction over long stretches of time, which is downward. Why do prices tend to drift upward year after year? Mechanically, think of an economy as a giant marketplace where more units of currency are gradually introduced over time, whether through lending, government spending, or the normal expansion of a growing economy. When the amount of money circulating grows faster than the amount of actual goods and services being produced, each individual unit of money has to stretch across more transactions. Stretched thinner, it buys less. That is inflation in its simplest mechanical form: more money chasing a similar amount of stuff, so each unit of that money loses a little bite of purchasing power. It does not usually happen in one dramatic jump. It happens quietly, 1% or 2% at a time, year after year, almost invisible in any single month but unmistakable across a decade. This is where the invisible leak comes in, and it is the part people miss the most. If you hold cash and it just sits there, doing nothing, earning nothing, you might feel like you are being careful. You are not losing money, right? The number in the account is not going down. But mechanically, you are being taxed anyway, just not by a government collecting anything visible. You are being taxed by rising prices eating into what that stationary cash can buy. Every year prices creep up a little, the silent tax collector takes a slightly bigger bite out of your pile, and no bill ever arrives to tell you it happened. That is why inflation gets called a quiet, invisible cost. There is no line item. There is just less purchasing power than there used to be. Now here is a tool that makes this concrete and genuinely useful: the rule of 72. It is a quick mental shortcut. Take the number 72 and divide it by a percentage growth or decline rate, and you get roughly how many years it takes for something to double, or in this case, halve. Say prices are rising at about 6% a year, just as an illustrative example, not a prediction. 72 divided by 6 is 12. That means, roughly, in about 12 years, prices could double, which mechanically means the same pile of cash, unchanged in number, would buy only about half of what it buys today. Even at a gentler illustrative rate, say 3% a year, 72 divided by 3 is 24. 24 years, and that unchanged pile of money has, in real terms, lost about half its punch. This is not a scare tactic. It is arithmetic. It shows why a slow, boring, small yearly drift becomes a massive change once you let time compound it. This is exactly why a big pile of cash sitting completely still can feel safe and mechanically not be safe at all, at least not against this particular threat. Cash under a mattress, or sitting completely idle for many years, faces zero risk of the number going down. But it faces near certain risk of losing real purchasing power, quietly, every single year, through that invisible leak we just described. Safety is not just about the number staying stable. Real safety has to account for what that number can actually do for you later, which brings us to one of the most important distinctions in all of personal finance: nominal versus real. A nominal number is just the raw figure, the number on the screen, unadjusted for anything. A real number is that same figure adjusted for the effect of rising prices, showing you actual purchasing power rather than a lonely digit. If your income grows 5% in a year, that sounds great in nominal terms. But if prices also grew 5% that same year, your real, inflation-adjusted position did not move at all. You are exactly where you started, even though the number on your paycheck looks bigger. This single distinction, nominal versus real, changes how you should read almost every financial headline, every account balance, every long-term plan. The number alone tells you very little. The number relative to the shrinking or growing power behind it tells you the truth. So what is the calm, practical takeaway from all this machinery? It is not panic, and it is not a specific instruction to buy any particular thing. This is general education, not personalized financial advice. It is simply this: money that just sits, completely inert, tends to quietly lose ground to rising prices over long stretches of time, and understanding that mechanism is what lets you ask better questions about your own numbers. Is this actually growing, in real terms, or just growing in name only? Once you start automatically translating nominal into real, you start seeing the financial world with much clearer eyes. This is Money Mechanics. One money rule at a time. I will see you tomorrow.